Thanks for coming today. I know that your time's valuable, so I appreciate you joining us. Hopefully we won't take too much out of your day. Today we're going to run through how to identify commercial opportunities using the existing information that you have. And what I'm talking about is things like financial statements, tax returns, contracts, just information that you get in your everyday residential broking business, and how you can step into the marketplace and what segments that you can have a look at. So where can you find opportunities? Well, you can start off with any tax return or financials that you receive from a self-employed person or a business owner, and I'm going to show you an exact example of that today. You can have a look at any vehicle or equipment leasing that you might be doing. So just remember that when you do a car loan, if you're doing a vehicle loan, for example, you can, or you are, or you should be, getting an asset and liability position of the applicant, of the business or the people that are applying for the loan. And at that point, even though you might only be doing, say, a $50,000, $60,000 vehicle, you've now got an opportunity to look at all of their other business and to talk to those people later on about how you can help. And that might be a home loan, it might be business loans, it might be some overdrafts or other business debt that's sitting there on their asset and liability position. The other opportunity, I think, is for self-managed super fund lending, and I particularly like commercial premises purchasing. And why do I like that? Because most of the time, the applicant for SMSF lending is actually a business owner, and that means that whilst you're doing their self-managed super fund lending for their premises, you're also receiving their financials. So you're getting a chance to have a look at the business itself, the loans that they've got, and you're receiving their asset and liability position personally. And so that means that you're not just looking at the SMSF, but you're looking at the business lending, you're looking at whatever is on the balance sheet in terms of liabilities for the business, and also what's on the personal balance sheet. So there's just a few different places you can start to look for opportunities in the commercial arena. You don't have to do everything at once. It can just be, take one opportunity, and it might be just vehicle financing, and every time you do some financing for a vehicle, you have a look for an opportunity. So I said I was going to show you an example of where to find opportunities in business financials. And so there's a couple of things I want to show you. First of all, you might receive financials, and when you're doing a home loan, you're thinking, look, this is just an income document. Where am I finding these numbers? I've got to get this loan approved. What can we use for servicing, etc.? And part of that process will be that you'll be adding back some of the expenses like depreciation and interest, etc. And so I need you to think about, well, if there is depreciation in the profit and loss, it means that there's an asset which is being written down in value. And then the trail will lead you to the balance sheet, and you'll be able to see, well, what is that asset? And then you can have a look at, well, should they be, will they need to buy another asset like that? It could be motor vehicles, it could be equipment, it could be commercial property. There's some kind of asset being depreciated. And so we're going from an income document, which is your profit and loss, to an asset and liability document, your balance sheet, and you're finding out what are the opportunities on that balance sheet that you can finance. So I want to focus on just a few things on the profit and loss. The first one is depreciation, as I mentioned. Interest in this case is quite low. What does that tell you? Well, it means that this business itself, this entity, has a very low level of lending. It does, however, have a reasonably high level of motor vehicle expenses, so that tells us, well, either there's some large vehicles that are costing a lot of money. Maybe it's a sort of business that has high fuel costs, etc. Or it might mean that they've got a lot of vehicles. So just think about the type of business that you're looking at, and do they need more vehicles or more equipment, or what are the types of assets that they would like to buy? The other items that I want you to have a look at are things like rates and rent. If a business is paying rent, have they thought about buying their own premises? Could they buy that premises in their self-managed super fund? And you'll see in this case that rent's about $200,000. That's a lot of rent. That could probably finance a lot of building. Maybe it's a $1.5 million purchase, something like that, where you've got $1 million loan. The interest on that's probably going to be about $70,000 a year at 7%. So $200,000 rent will cover a lot of that. It might mean they need a lot more space than that, and the building has to be larger. But it's an opportunity to ask the question of the business owner, what's your lease like? How long has it got to go? Have you thought about buying your own premises? So maybe you've got these financials because you're doing a home loan, but here are the opportunities in the business space that you can talk to the owners about, or your clients, your home loan clients about, later on once you've got the home loan through. So bringing you to the balance sheet, there's a few opportunities here for financing. So remember, we looked at the profit and loss, we looked at motor vehicle expenses and depreciation, we looked at interest, so we know the loans are low, but we needed to have a look at what was being depreciated. And in this case, you're finding that there is plant and equipment and there's a large motor vehicle balance, and we'll get that to get to that in a moment. But also in the balance sheet are some trade debtors. Now, trade debtors, if you don't know, are basically the invoices that people have not paid yet to the business. So it's money that's owed. And there's a nice, really easy LVR here. If someone has trade debtors of about 400,000 or 500,000 sitting on their balance sheet, they can borrow against those if they want to or need to for working capital purposes using trade debtor finance. And typically the LVR that is lent or borrowed against it is about 80%. So from a home loan or residential broking point of view, that's fairly easy to understand. What are your trade debtors? 500 grand. Great. We can get you 400,000 against those typically if you need help with working capital. And sometimes it's a better alternative to trying to apply for an overdraft, which at that level could mean they need property security, which is your home that you're financing. So let's focus on the other assets on the balance sheet. And I want to focus on motor vehicles because we saw high motor vehicle expenses and we saw high depreciation. So what we can tell here is that at some stage, we've had around $300,000 worth of motor vehicles. It's quite a lot. It might not be. Let's just say it's 6 vehicles at 50 grand each. It probably isn't, but it could be up to 6 vehicles at that level. And the depreciation amount is quite large as well. We've only got about $30,000 or $40,000 worth of value left. And that usually means that the cars were purchased a little while ago and are now old. When I say old, I mean, maybe 4 years, something like that, maybe more. They've been depreciated down quite a bit, and that's an opportunity for you. So again, I'll go back to you're doing a home loan, you're noting the expenses, you're looking at the balance sheet for opportunities, and once you've completed the home loan, where is the opportunity to step into business lending for these clients? Well, they pay rent, so there could be a commercial purchase. It could be under their SMSF if they've got one, and they've got large motor vehicle expenses, and they've got a large amount of vehicles on their balance sheet which are not worth a lot at the moment. So where do you find that information? What vehicles are they? Well, you can have a look on the depreciation schedule. You'll find that in their financials and tax returns, and it'll list all of the assets, and I've just singled out the motor vehicles in this case. And in this business, what you'll find is that there's a Hiace and there's a Porsche and there's a few other vehicles there, and you'll find that the average age is somewhere around 5 to 7 years because they bought them in 2018 and 2020, and now they're not worth much. So here is the opportunity. You finish the home loan, and then once they've moved in and they're very happy with the situation and happy with your service, then you can reach out and have a conversation and say, hey, I noticed when I was doing your home loan, I ran through the financials. I'm just wondering, are you thinking about buying any new vehicles? I see that the values come down on those, and they're 5 or 7 years old. Are you thinking about that in the future? And did you know that we can finance that for you? So there's just one specific opportunity to talk to a client using the information that you're getting for a home loan to go back to them and ask for business or commercial lending. There's plenty of other opportunities, and really this just comes back to the conversations that you're having with these clients, learning about their business. As you learn more about their business, you will uncover opportunities. So as you learn about how they order their stock and pay their bills, how they service their clients. So for example, if they're an electrical firm that does is an electrician for houses, they might have 4 or 5 staff, they might have 4 or 5 vans. When are those vans leased? Did you see those on the balance sheet depreciation schedule? Not just the cars that we've talked about here, but other businesses need vehicles. For example, a real estate property management company. They'll often have vehicles for their property managers. So that's an opportunity. If they're importing stock, they might need trade finance. Learning about the business uncovers these business finance opportunities, and you do not have to do everything at once. You can just step in, just talk about SMSF commercial, just talk about car financing, just talk about trade financing. Choose one of those, if you like, as your niche. The other thing I wanted to do today was talk about the most common inquiries we get outside of just business lending. And we see a lot of development lending coming through, and that's smaller development lending, so under $5 million. It's typically like knock down a house and build 2. We also see a lot of SMSF inquiry and private lending. And private lending, is really just non-bank lending, and it's often just based on assets. So it's, I've got a house or I've got a commercial property, I need 500,000, I don't have financials, what can you do for me? So I'll explain that a little more. So with development finance, the key thing is land. Do the clients own the land? Often you'll have first-time developers, or when I say smaller developments, again, I'm sticking to the under 5 million part. A lot of banks don't want to finance anything under $5 million. It's just not worth it for them. You've got the risk of the loan as well as the return that you're going to make, and they just cannot charge enough for the resources that they put into it. And so you'll find that it's really under 5 million with first-time developers or smaller developments. We're looking at some non-bank providers. And those non-bank providers require a certain amount of equity in the deal, and typically it's about 30%. There's going to be some jargon, which I'll get to in a moment, but a rule of thumb for you if you're a residential broker is if the clients own the land outright, then they usually have enough equity to go in the deal, and that's the first part. If they're coming to you with a house that's worth 1.2 million and they already owe 900,000 on it, then they probably don't have enough equity to turn it into some townhouses. And some people make the mistake of thinking, well, I can borrow against the end value. And that is true, but you still need equity in the deal. And so I'm going to give you the formulas for working out how you can tell if a development deal can go forward or not. The first thing we're going to do is talk about jargon, and you're going to hear plenty of it. GRV, NRV, TDC. These acronyms are thrown around all the time. So here's the explanation for them. GRV is gross realizable value. What does that mean? It means if I've got 10 units and they're worth $1 million each, my GRV is 10 million. NRV is net realizable value. What does that mean? It means typically my 10 million GRV less GST, because the developer has to pay GST when they sell. And so if I was to take over this development and sell it, I would have to pay the GST. And I make that really easy for you without getting into the actual numbers, but if I've got 10 million bucks worth of property, and I pay 10%, let's call it 900 or let's call it $1 million. Now I've got 9 million worth of NRV. And that's important because the bank will lend you against that future value, that net realizable value. And then I've got TDC, which is total development cost. Total development cost encompasses a lot of costs, but basically described, it's what's the land worth and what's the construction cost. And then there's some other things like marketing and other soft costs like architects and engineering, etc., which are not the actual construction. But anyone doing development will have a feasibility, will know what it's going to cost them to build this development. And then there's two calculations to think about. How do you work this out? Okay, how much can you borrow? Well, you can borrow either, usually 65% of the net realizable value, or you can borrow up to 80% of the total development costs. So if you're on the phone to someone who's asking about a development, all you need to know is these numbers. So first of all, do you own the land? Yes, I do. Okay, what's the land worth and how much will it cost to build? And then multiply that by 80%. That's the amount of the loan that they can have. Or how much is it going to be worth at the end? 10 million. Well, let's take GST off. Let's call it 9 and multiply that by 65%. So once you have those two numbers, it's usually one of those numbers, and it's usually the lower amount that's available. And that includes interest costs as well for the term. So you can borrow, 5.6 million, but there's $200,000 worth of interest over 12 months. And so your actual net amount is 5.4. So that's a really quick way of deciding, is this a deal or not a deal? Private lending, I'm going to call it that, but really it's non-bank asset lending. It's a growing market, and the reason it's a growing market is because people often want a solution. And if you're talking to a client about a solution, then pricing is an issue which, whilst there are different lenders, they have to understand that the pricing is going to be higher because there's less questions. But when we are talking to people about private lending, there's a range of solutions and problems we're going to solve for them. And so as a residential broker, don't focus on the pricing per se, but focus on how you're going to get this deal across the line for the client and what is the problem you're solving. Sometimes they won't tell you what the problem is. Sometimes they'll say, I need $500,000. Okay, what's it for? Well, we need to do some expansion of the business, and we need to buy stock, and but really there's an ATO debt somewhere that they're trying to clear and they're too scared to tell you, and you've got to tease that out of them. ATO debt, by the way, can be cleared with private lending. So There's a range of solutions, a range of providers in the private space. They will lend against assets, and those numbers are typically up to 75% against a residential asset in a metro area like Brisbane, Sydney, or Melbourne. That number is around 65% if it's a commercial property. And there's some other numbers, there's some other different ones for land, etc. But if you stick to that 70 to 75 for resi, 60 to 65 for commercial, that's how much you can borrow on a no-doc asset lend. So there's no accountant's declaration or BAS. It's only for business purposes though. So you cannot do this for regulated products. You cannot have someone borrowing to buy an owner-occupied home in this situation. It's a business that's borrowing the money for business and commercial purposes. And you have to be really clear on that before you step into the market. Okay. Last but not least, self-managed super fund lending. It's my favourite. I know that there's some issues around legislation that might be upcoming in terms of taxes, etc., around SMSF. But for now, there's plenty of opportunity in this space. And as I said before, I like it because there's a commercial opportunity to do, a commercial premises with SMSF usually leads to a business owner, which usually leads to business lending and then home lending. So you can actually grow your home loan portfolio by focusing on SMSF. And plenty of you have providers for this. So many of your aggregators are already providing SMSF options on both a commercial and residential basis. If you become an expert in that, it is very niche, but if you become an expert in that then and get the right referral partners, you'll start to build out not just SMSF lending, which is long-term and quite sticky, but also business and commercial and your home loan portfolio lending as well. So you're getting plenty of opportunity just by getting to know the SMSF commercial market. I've also included a diagram there that tells you how SMSF works, the structure of it. Just to understand that, one thing that is important is that clients don't go off and sign a contract for a purchase of a property in an SMSF on its own. There needs to be a bare trust or a property trust, whatever you want to call it, but there needs to be a separate entity that holds the asset. And if clients don't know that from the start, please talk to them about getting advice from their financial advisor or accountant, whoever's setting it up for them, before they start signing contracts. In summary, use the information you've got right now for business and commercial opportunities. You do not have to go out to the marketplace telling people that you do commercial, although I suggest you do. But if you want to be quiet about it, that is, you want to learn as you go, just choose one opportunity like self-managed super fund, like private lending, like development finance, etc., or like vehicle and equipment financing for businesses. Look for those opportunities in the information you've already got, and then approach those clients, letting them know that you can offer that service if it's something that they're after. So I just want to thank you for your time today. I hope you've learned something out of that. If you need anything else, please reach out to Xenium. We are specialists in business and commercial financing, and happy to talk to any residential broker about the help that they need. We help 1,000 or more brokers across the country with business and commercial financing, and look forward to seeing you soon.